I would now like to invite on the stage FLORIN Toma, because Romania is a very good example of a country which just recently in the last decade had to amend their accounting system to conform with the old accounts directive and are now changing, facing the challenges of the new amendments.
Thank you, Peter. I will begin by giving you some general information about the Romanian environment, and then I will entertain you with some of the challenges that we have in implementing the new directive, finishing by imagining some drivers for an optimal adoption in my jurisdiction. So Romania is a relatively new member of the EU, joining the EU in 2007. It is a young capitalistic Eastern European economy. Before the accession and after 1989, the Romanian economy was a heavily regulated environment and still is, especially in the tax and financial sectors. That said, it is implicit that following the accession, the national legislative footprint is very present, making the harmonization with the EU quite complex. The accounting field was particularly faced with several transformations, from a patrimonial accounting system linked directly to the tax, passing through the implementation of the IFRSs and adoption of a conceptual framework which we still have, to the adoption of the EU directives, Romania being one of the first countries to adopt the EU accounting directives. Public interest entities and those above certain thresholds are audited. And for reporting purposes, we have a micro-regime today consisting in companies with less than 35,000 euros sales and assets. Specific to the Romanian economy is the structure, which is dominated by the small and medium enterprises, although many countries in the EU have the same structure. 98% of all entities are small companies with turnover of less than 2.5 million euros and less than 5 employees. According to some statistics, Romania would be number 2 in the EU in terms of percentage of small companies in the total business entities. Concerning the new accounting directive, I will not repeat what my previous speakers have already said. However, it is clear that there is a significant number of options out there to be chosen from, and a number of accounting issues on which the directive is silent, such as, without getting too technical, leases, the definition of assets and liabilities, long-term contracts, and so on. The options, even if they are a challenge for the adoption, they give the member states the opportunity to balance their national conditions with the objective of having a better accounting reporting system. The directive proposes a new company classification aiming at the maximum harmonization for small undertakings and a micro-entity regime. The threshold for small, medium, and big companies have already discussed. And also the directive has a stronger emphasis on the fundamental principles of going concern, prudence, substance of a form, and materiality. So what are the challenges, some of the challenges that we face in adopting this new directive? One of the main challenges of the implementation is the new company classification. In terms of numbers, compared to the old classification, more than 600,000 companies out of 634,000 in Romania today would fall under the micro-regime if the indicated thresholds are applied. The whole economy will be formed of micro-entities. It means that due to reduced reporting requirements, almost all companies in the country would have a less degree of transparency. That could lead to an apparent reporting simplification for companies, but would pose a problem in the relation with banks, shareholders, and investors. And where transparency is a concept which historically was difficult to be accepted in countries like mine, and still is sometimes, that could lead to real difficulties and increased costs in fulfilling the needs for information of various stakeholders. Small undertakings should be transparent with their shareholders and business partners. On the other side, the issue of assurance for such companies has been long debated and remains one of the concerns. The new directive is also an opportunity for countries to reconsider the public interest companies classification at national level, a very delicate process, if not managed diligently at regulators' level. The consequence could be that similar types of undertakings in Europe be treated in a different way in different member states. Substance over form is another option that the regulator could consider by exempting small undertakings from applying it. In the recent past in my country, reporting was linked to the legal form and tax, and our profession supports the principle of substance over form, having experienced how doing otherwise was misleading for the readers of the accounts. I do not think that such an option should be considered. And finally, prudence as a principle more powerfully emphasized in the directive is good news. It is a challenge not in terms of an option, but as a practical application at companies level when we are talking about the accounting decisions versus the tax considerations. So how can we get an informed and efficient implementation process? I think that first we need to involve, the regulator should involve all national stakeholders in the process. Financial statement preparers, auditors, businesses, banks, and so on. And they should partner with the accounting and auditing professional organization, as they can give significant technical insight and feedback about the various options in their application. I'm pleased to see that in some draft legislation in our country, consulting with the professional organization would be a mandatory legal step in adopting new accounting regulation in the future. Secondly, no decision should be made without a thorough evaluation of the impact of various options, especially for simplification purposes. In the process, only the relevant options should be tested, where relevance requires a full understanding of the environment in which companies are operating. The above steps that I've already discussed could help in this respect. At SME level, and not only there, we are still living in a world where tax treatments weighs heavily over the accounting decisions. The tax consideration influence on the fair value is still important, especially when standards and regulations leave doors open to such an effect. A total disconnect in practical terms is quite difficult, but legislation should encourage and impose the process. Last but not least, simplification is not relevant unless the information appetite and needs of stakeholders in a specific environment are not met. In volatile economies, a lot of information that is suppressed at small undertakings level, like significant post-balance sheet events, movements on reserves, components of change in tangible fixed assets or especially related party transactions, could lead to poor reporting with significant unforeseen effects for governments and users. Think small first, applied effectively, should remain the basic principle in changing any regulation. Thank you.